So hey there, this was an interesting chapter. That was actually, for me at least, was one of the hardest chapters until now, because it started easy, basically talking about volume and open interest, and basically new things. He didn't necessarily explain open interest, but after a simple lookup, you can see it's the total amount of outstanding contracts on a given stock, right? But at the end, he just casually mentioned put and call ratios and stuff, and you really have to dig into it yourself, because I'm not sure if he mentioned it in the upcoming chapters, but it's quite something. And I thought at first it was going to be the same as shorting and longing. Turns out there's actually a difference, and I'm still not sure. But let's just get on with it. All right. So basically, these are the most important things I sort of took out of the chapter, which I'm going to go over. So basically, what this is, it again shows why volume is important to a rising bearish or a bullish trend. But we already knew this, right, from the previous chapters. But in this chapter, he really talked about why it is actually interesting to volume to rise during a uptrend, right? So let's just get started with it. So basically, what I'm gonna want to talk about first is about open interest. So too long, right? So basically, just gonna go over it, okay? When you buy a long, basically what you're doing is actually you're gonna buy the stock in the hope the price will rise and you're gonna settle at a high price. Easy as that. When you go short, you actually sort of rent the stock from someone, but he is forced to buy it back from you at the price. Most of the time, at least in derivatives trading, he's forced to buy it back, or the other person at the price you went into the trade. But it could be that let's say the stock is now 50 and it's going to go to 40, and you're going to go into a short option at 45, sort of. But this is a put option, but I'll get into it. But basically, meaning if there's a new outstanding long and the seller actually sells his short, there will be an increase in open interest because there's more contracts for longs and there's actually more contracts for shorts. It might seem a bit counterintuitive, but selling shorts is actually a good thing. Or yeah, it's a good thing because basically it will have more money sort of in the market. Basically, okay, it's sort of like renting something. All right. So there will be no change if there's new longs and there's old longs are being sold, because well, those cancel each other out, right? The same is for buying and selling shorts. And there's a decrease if there's gonna be bought old shorts, basically meaning the money's gonna be taken out of the market, right? Because you or someone else has rented that money and he's forced to buy it back at the current price. And basically, when you sell a short, could be at a loss or a win. It doesn't really matter in open interest, because open interest is only about the active contracts that are open right now, and there's always one contract for a short and a long. Okay, that's important to know. So yeah, that's it for these ones. So let's get into the other basics. So first of all, it wasn't hard, but it was quite hard for me to really grasp the concept of open interest, because I couldn't really see the point of it matching to the graph. Because as you can see clearly right here, why is open interest increasing as this? And I really had to figure out and look, because I didn't really see a how do you call it, like a synergy between these, and not synergy but something else. But I'll show you actually right now. So basically what I'll take is open interest, and I'll take volume. That's not a good amount of volume. I want a show it up as a total line. I'm not sure if so I'm here again. The recording stopped sadly. But yeah, luckily I recognized it. But basically the main thing about the open interest and these three especially is most of the time they move together, and it's a great indicator of what is really happening to the market. There's actually a thing for it, yeah. So let's take this one for example, and let's look at actually this this thing in particular, which I'm meaning this downtrend. So let's say the price is declining and the volume is declining and the open interest is declining, which we can all see here. It's a strong sign. Why? Well, because it actually reached the bottom, and as you can see, it did reach the bottom quite quickly. Which really means people are gonna probably go long again. They could go short, but well, I don't think they would. Right. And let's look at another example here, which is not a good sign. So let's say the price is declining, but the volume is up, which it isn't necessarily, but let's say it almost is. But as we can see, the open interest actually goes up with this one, which is going to be a weak market sign. And as you can see, it actually bleeded sort of until, well, didn't get back up here until now, but it went down further. So this is like a pretty good table of really indicating what is happening. Oh, we can also actually look at it from a rising standpoint. So let's say the price is rising, open interest, not a whole lot is happening, but let's just say it's going down, which actually it is kind of. And the volume is going up. It's also a strong sign, but especially what's really good if everything is up. As you can see here, up, 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 up is a really strong thing. But you can basically see that they cancel each other out, sort of. Right. Yes, and let's get on to the next one. Yeah, this is basically what I'm having right here. Here is the open interest as well. I'm just gonna close these for some clear view. So, what you will see is actually the open interest happening. So basically, people actually cancel their contracts. Prices are still rising. Why? I'm not sure, but it's not a really good bullish sign. And as you can see, the price was actually declining after that, while open interest was rising again. I'm not sure if it's always a good idea to really have them sort of going on against each other. Could be. I'm not sure yet, right? So I'm not going to really judge that. Now let's get onto the on-balance volume. This one actually really has to look it up first, because like, what the hell's on-balance volume? But it basically measures the buying and selling pressure as an indicator, which adds the volume and updates. It adds it to the volume, and it subtracts volume on days that the price went down. So what you will see right here is price went up, and of course, well, this one went up as well. But you will immediately see a downtrend when the previous price of the previous day was actually less, and you can see it actually declining. So basically, it's really similar to the thing before. But the thing, what is easy is you can easily spot a price difference. And I guess you can see really it when it's looking at the price, right? Because it's basically subtracting the volume. Only the volume is not shown in this chart. I guess it's really a good thing, but let's just get the on-balance volume on here, on balance volume, here it is, and really showcase it working right here. So basically what you can see right here is a couple of negative hours, to be honest, because I think this one goes hourly as well, but to be sure, let's go on the daily. Let's put it on auto. So what you will see, update, every day is like roughly the same amount of volume. Here, a lot of volume actually declining. And as you can see on these updates, there might be a bit of an uptrend. It's not really as significant as the previous peak, right? So what you will see, price declining. We can also look at it from a smaller field of view. So basically what you can see, prices doesn't go higher, as well don't do the peaks. Here it did. Yeah, what's to say about this? Not really sure actually. I'm not sure if this is a great indicator. It's an indicator, which you mentioned. So yeah, I guess do what you want, but that's there. Right. And now let's get onto it with. Where's the rest? Oh, it's here. Okay. Right. So this one wasn't that interesting, but it's basically talking about a blow off tops and blow off bottoms. So basically meaning like a really rapid change in price, and oftentimes immediately getting back down again. So for example, I guess already you can see it here, immediate price uptrend, and it gets back down again. The thing is, it's really hard to really see when this is happening, and it could as well be a breakout or a fake out, or it could really be anything. and it's really hard to like predict these market trends. And I've actually tried. I've really tried to sort of, when the price was rising that fast, I was like, yeah, I'm gonna just go for a short right now because the price rose up so high. But it could just as well mean it's not going to go back up again, because basically, let's take an example right here. You're seeing the price going here, and it's like, oh wow, this is a really good action. I'm just going to go for a long again, right? Because the price also went long and went back down again. So, well, I'm going to do the same here. Now, this is a red flag because you never want to really go long after the price has already gone up. This is sort of a fake out. But again, you can see it declining further and further, and you could say the same about this price declining really, really rapidly, going to the bottom at 16,000, and immediately going back up again. But especially if you're here, what you can see if you zoom really in on this, it's really hard to really predict it, right? Because it could just as well mean a downtrend, and if the price stops here, well, it could just be an like a trend pattern, sort of, right? Because you can see a bounce, 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 and bounce. So it could just as well mean it's going to go down again. Oh, it's the wrong one. Could just as well mean it's going to go down again, but it could also be it's going to be a bounce and an up, or like it could really be anything. So I guess these things are kind of hard to predict. So yeah, just don't play with those things. So let's get on to the, what's this? Oh yeah, this one. Basically, this one is quite interesting, and I was actually didn't really think about it. But basically, what this goes over is the commercials, the speculators, and the traders, basically. So what you will see, it's kind of hard to see really, but what you can see, these are commercials at the top line, and you've got the, let's see, well, the speculators is the dashed line, and the dotted line is the traders, basically. And basically, what they're implying here is a lot of the commercials, so like the big companies, are really buying, buying, and the sort of smaller traders actually not that positive, and especially when there's a huge difference in between these. For example, let's say here, right, this is a good buy option, or here's also you could buy. They just pointed out, right? But basically, follow the commercials is what they're saying, and I'm not sure if there's like an indicator for that. Commercials index bushy maybe. Not really sure. Is it there? Oh no, not 2 times. Let's see. I'm not sure if it's gonna load or if it doesn't load anything. I haven't tried this one. I don't think it will. Right. So, but follow the commercials is basically what they're saying. I guess maybe it does show up on like Meta. No. I'm not seeing it. Well, it's fine, right? Where is it here? Yeah. So that's interesting, I guess. Follow the commercials. And this one is at a downtrend again. So basically, when the commercial's at the bottom, it's good to go for a short. Basically, when it's below zero, it's going to go for a short. When it's above zero, it's going to go for a long. You can see a lot of the traders are actually not particularly doing that great, but the commercials are doing that great. All right, so now let's get into the confusing part. All right, let me just first take this as a sort of big overview. So basically, really at the end of the chapter, he mentions put and call ratios, and he mentioned it like it's nothing, basically. It's like a couple of sentences and he moves on. But I'm like, what the hell are put and call ratios? And first when I was looking into it, I thought it was the same. And I'm still not really convinced it isn't the same, but there is a significant difference. Right? So let me get into it. Let's go look at the examples first, and then let me take this one with this one. Sorry. Right. So let me just go over the definition. So basically, a call option is a contract between two parties exchanging a stock at a strike price per predetermined date. Right. So basically, what they're doing is actually, sorry, this is a good example right here. So this person is going to buy the price for a 55 strike price, and he will, let's say the price rises to 60. So yeah, sorry. I sort of had to reread it because I sort of forgot. Because to me, it's these put and call options are kind of similar to each other, and I'm still not really sure what the difference is. I guess the only difference really is there is sort of a buy price or like a sort of seller price. I'm not sure, but I'll get onto it. So what I wanted to show you is a call option is most of the time it's gonna go up, right? So let's say this person is gonna open a call option that's 55 euro dollars, and the price is gonna go up to 60. This means he made €5 or $5 profit on that call if it reaches that, right? He pays actually a 20-cent sort of fee, which the seller is always going to keep. Doesn't matter if he loses or wins, he's going to lose 20 cents. Which might sound like a lot, but it's really, you can make 5 and all you will lose is 20 cents. So I'm really not sure where that. It seems like you always win, right? If that is your win-loss ratio of like 4%, you can do what's like 25 trades before losing. So I'm not really sure where it, like, I don't know. I'm not. Maybe like this is where Warren Buffett really got his money, because basically you win one in every like 1 in 25 and you're good, right? But I'm not really sure where it comes from. So, but basically what it means is you're gonna really make an example. Actually, the house is a good example. So let's say this is one. Susie's gonna sell the house for 500,000, but Sammy will actually pay a fee of like 1,500, and he's saying, all right, keep the house off the market for 3 months, and I'll buy it for you at 500,000. Now Peter is actually gonna make a nice park, which will further increase the price of the house, and well, now the house is worth 600,000. Well, that's good, right, for Susie? Well, actually it isn't, because Susie promised Sammy to sell it for 500,000. So now Sammy can actually choose, do I want to buy the house? Because he did pay like a 1,500 fee, right? So he lost 1,500, but he made around 100,000 on the house if he buys it now. And now Sammy can actually choose to buy the house or not buy the house at all, right? So, and this is basically the same as a put option, but I'll get onto it in a second. But it sounds to me like a great deal, but I'm not sure if like this 1,500, which they used in the video, is like similar to what they use in real life put and call options. But if it is this way, it's still like, I just don't see really how you can lose money with this strategy. So I might get into it, but it sounds like, I don't know, it sounds weird, right? Because you're risking 1,500 in like the case of winning 100,000. But maybe those references are not really good at all. I'm not sure as well. Right. So let's get on to the negatives as well. So basically, this is a put option. You can read the explanation if you want here. But basically, what will happen here is the put option is actually, there's a predetermined strike price, which I believe when I trade derivatives, I know there's going to be a contract between one person, but that I'm almost certain that person has to be a computer, right? Because the moment I engage in the price, it is bought, and the moment I want to get out of the trade, I can immediately sell or buy the short, right? So it has to be in a computer. But I was kind of digging into it, and they're all saying you're against another party, and I'm like almost certain the party's going to be a computer, but I really haven't figured it out yet. Right. So yeah. Let's get on to it. So basically, what will happen here is this: the same house again. So here you have Susie and Sammy again, but basically the same thing happens. Sammy pays a sort of a 1,500 fee to Susie to keep the house off the market for 3 months, and he's saying, I will probably buy it at 500. So the price is strict, right? The price is really certain. It's 500,000, not more, not less. It's 500,000. It's the contracted price. It cannot change. Sammy is the one who can actually choose to either buy the house or not buy the house at all. Right now, he's probably not going to buy the house because he lost 100,000, even though he paid 1,500. Right? It's not really adding up, because Harry just is going to make like a cheap flat next to her house, which is going to drive her price the house, the price of her house down. So that's it, simply put, for put and call options. And as you can see, it's here as well. So basically, what you're doing right here is it's sort of similar to a short, in my opinion, but basically you're you're making a contract between another party in the future. So let's say I've got an apple worth 10 euros, and my neighbor essentially, or sorry, let's say my neighbor has an apple, and I'm gonna loan it off of him. All right, so I'm actually like sort of I'm selling it sort of. But I'm just loaning it. So I'll get back to it. But basically, in 3 months' time, when I'm gonna buy it, man, this is difficult to explain. Basically, I want to buy it again, but the the price um, we agreed to is that I'm gonna buy it at 12, but the price rose to 14, right? I will lose because the price rose to 14. Sorry, I will make money. Sorry. So basically, the price is at 14 now, but I promised I will buy it at 12, so I made a €2 profit. If it goes the other way around, so let's say the price is now 10. It's good to go both ways, right? And the price drops down all the way to 6, but I promised to buy that in for 8, right? I will lose €2. I'm not sure if that's a good example, but I did some research, and I'm still not really sure on what it is exactly. So yeah, the third scenario being nothing happens, no one buys the land, not either the construction worker or the park builder. So the house will stay the same, and Sammy can choose if he wants it or not. And he will still lose that 1500, which is to Susie. It's the risk of the thing, really. And yeah, and that's pretty much it for this video. It was kind of a hard one, to be honest. So yeah, I'm not really sure. It was a hard one. It's gonna be a long video as well. So